Well, good afternoon, everyone, and welcome to our second webinar presented by Ability First and Lagerlof. Many of you joined us last week, and we're glad to see you all for today's session on IRA, charitable rollover, retirement assets, and donor-advised funds.
I'll wait until we see.
Before we begin, I want to let you know that Spanish interpretation is available for this session. Our interpreter today is Mark. Mark, could you please share instructions in both Spanish and English on how to access the Spanish language interpretation channel?
Will do. Thank you, Lana. Yes, we'll start that off for the benefit of those listening in Spanish. Muy buenas tardes. Aquellos que nos acompañen el día de hoy que quieran escuchar el programa en español, por favor busque el icono de un globo terráqueo que aparece en la parte inferior de su pantalla que dice Interpretation o Interpretación. Selecciónelo y de ahí seleccione su idioma Spanish o español y así podrá escuchar el programa enteramente en su idioma. And for those listening in English, in the event that there's a Spanish comment or question, you can also hear a live interpretation of it by selecting the globe icon at the bottom of your screen that says interpretation, and then selecting your language, English. Hey, Lana, thank you. Back to you.
Thank you, Mark. The Spanish channel is now enabled, so anyone who would like interpretation can join that channel. If you like to continue listening in English, no additional steps are needed. As a quick reminder, please keep your microphones muted to minimize background noise. I would also like to note that we will have time for questions and answers at the end of the presentation, so please be sure to submit your questions in the chat. We will do our best to address as many questions as possible. Before I hand it over to our presenter, I would like to introduce myself. My name is Lana Masarian, and I'm the Director of Development at Ability First. We're honored to be one of Lagerlof's charitable partners. Ability First is a nonprofit headquartered in Pasadena, serving children and adults with developmental and intellectual disabilities. Founded in 1926, we are proudly celebrating our centennial this year, marking 100 years of impact and service. Our mission is to support individuals with disabilities in achieving their personal goals, building confidence, and fostering a strong sense of belonging. Our programs include after-school enrichment, employment services, college to career pathways, community integration, aquatics program, and summer camp. We have a beautiful camp in Crestline. We serve communities across Southern California with centers in Long Beach, Inglewood, East LA, Pasadena, Claremont, and Crestline. We will share our contact information and website at the end of the presentation, and I would be happy to connect with anyone interested in learning more about Ability First and our services. With that said, it is my pleasure to introduce our presenter, Josh Driscoll. Josh is the managing partner at Lagerlof and chair of the Private Client Services Department. He specializes in estate planning, wealth transfer, and business succession planning. Josh, thank you so much for taking the time to educate us on IRA rollover, retirement assets, and donor advised funds. We appreciate your time and expertise and look forward to learning more today. I'll turn it over to you.
Awesome. Well, thank you all. And hopefully we have a lot of people on here that have joined us for the first webinar. If so, this is totally different. You're going to hear some additional and different topics today. If you didn't go to the first webinar, that's okay. This one's independent, so you're not going to feel out of place. We'll do a little bit of a review of that webinar, but it is available. I know you can watch the recording, so feel free to do that. So again, we're going to do a little review of the March 17th webinar, which was really about estate planning basics. You know, what makes up an estate plan, a will, a revocable living trust generally, durable powers of attorney, healthcare directives, those types of documents really was the focus of the March 17th webinar. So if that's something that either you were there and you need to watch it a couple more times for it to sink in, great, watch the recording, or if not, go back and watch that. It's super helpful for a lot of folks. We've gotten some feedback there, so great, and thank you for that. We're going to talk today a little bit really about charitable intentions and IRA planning and some of those things we didn't get into a lot. on the last call. So definitely going to talk about IRA charitable rollovers and what that means and how to utilize them. How to avoid tax on rollover gifts. There's sort of the same effect can occur, but you can have two wildly different sort of tax scenarios when you're doing rollover gifts. So we're going to talk about the best way to do that. We're going to talk about gifts that are not subject to deduction limits. So generally, when you make a gift, you're all probably familiar with that. There are some deduction limits, right? It's not unlimited. You can't just give away, generally speaking, 100% of your income, right? There's going to be some limitation associated with that, but we can talk about gifts that aren't subject to deduction limits. We're going to get into charitable giving from retirement plans and how you can potentially do that. We'll talk about donor advised funds and also probably private foundations, charitable foundations, things of that nature. Those are all kind of entwined with each other. And then the charitable income tax deduction that we'll get into. And we definitely will reserve some time for Q&A. I'll try to keep my eye out if there are any questions that are put into the chat, or at the end, we'll definitely have time for that. So feel free to do that. So moving in, estate planning and its role in charitable giving. So as you maybe remember from the last webinar, or just as a kind of a perfunctory initial thing to talk about, estate planning and charitable giving oftentimes go hand in hand, right? You generally hear about charitable giving in kind of two contexts: people giving things during life, making gifts to a charity, and they're seeing the benefit of that gift during their life, right? They're writing a $100 check to the Cats and Dogs Society, and that $100 is being put to use while they're alive, operating the charity or the foundation or whatever it is. And then you also certainly hear about people leaving charitable gifts either in their trust or in their will. And those gifts are generally, at death gifts. Sometimes they're larger than current gifts. It really depends on the person. And I've seen very, very large lifetime gifts and very, very large gifts at death. And there's no right or wrong answer. There are some distinctions and differences between the two that we'll talk about. And sometimes one may make more sense than the other, depending on your situation. So a great, typical, tenet of charitable giving is that it can reduce taxes in a number of ways, right? It can reduce it from an estate tax perspective. It can reduce it from an income tax perspective, which are both positives, right? Just kind of to wet your whistle, right? If you give something away to a charity at your death and your estate is otherwise taxable, meaning that your estate value exceeds whatever the estate tax exemption is for the year in which you died, whatever you're leaving to a charity is not subject to the tax, right? So you might have a $100 million estate, a $30 million exemption. If you leave that $70 million to charity, you will have paid no tax at your death. But if you leave that $70 million to your next door neighbor, they'll be paying tax on that. So that's just something to kind of keep in mind. Income tax wise, it's another deduction, right? You have if you are making a gift to a nonprofit or to a charity, making some charitable giving, and that will offset your income, right? Potential to offset your income, depending on the type of gift that it is. So that can reduce your income taxes, not necessarily your estate taxes. Obviously, this also can seek to enhance the impact of your charitable giving, right? And provide security for loved ones, depending on the structure, while supporting charitable causes. And we'll talk about that. There are ways to give assets to charities, but yet retain an interest from an income perspective. So that's definitely possible, and we'll get into that. On the last call, we talked about those essential estate planning documents, right? What important documents exist? Wills, trusts, which can be revocable or irrevocable, powers of attorney, and healthcare directives. Not spending too much time here because we spent a lot of time in it in the last call, but what are these documents? Wills, right? The oldest form of estate planning, if you will, right? the will is very basic, right? I'm leaving my assets to this person or to this trust or to this charity. Um, they are probated at death. A court and a judge must be involved in the probate of a will. But tried and true, but kind of expensive to administer. Trusts we talked about. They can be revocable or irrevocable. Most folks, if they have a trust, have a revocable trust. It can be changed or modified as your life changes or as situations change. That's a revocable living trust. That does not have to be probated. It can be very flexible. You're able to say, well, my kids are only going to get these assets if once they're 60 years old and once they've stopped smoking and they don't drink, or they do this, or they have a job here, or whatever. You can be very, very flexible and specific with a trust. Powers of attorney, right? What happens if you're unable to make financial or medical decisions? An agent under a power of attorney can make those decisions for you. Same thing with healthcare directives. That's just for medical purposes, right? Someone can make your medical decisions for you. All of those documents, plus a few others, are really what makes up a kind of like your essential estate planning documents. I wouldn't say that you have a completed estate plan unless you have all four of those documents. For most people on this call, technically, if your estate is worth less than around $200,000, you can avoid probate by using by just having a will. But anything over that that's not directly transferred on death, you're really best served by a trust. That amount is very low in comparison with most folks' net worth. So you can see why trusts are so popular in California. Beneficiaries and charitable giving. So beneficiaries as a general rule, receive assets at the death of someone, right? In order to be a beneficiary, somebody has to be leaving something to you at their death, right? And that can happen through a will, can happen through a trust, can happen through a transfer on death document at the bank, right? You go into Bank of America and you say, when I die, I want my daughter and son to split this account equally. Well, they're going to have you fill out a transfer on death designation, and they're going to say, okay, give us your son's name, give us your daughter's name, how to reach them. And if one of the two of them comes in with a death certificate one of these days, we will split the account in two and give each of them a cashier's check for the balance, right? That can happen. They are a beneficiary of your account, but through a transfer on death designation. And beneficiaries can include really anyone, right? They can be family, friends, charities, really anybody like that can be a beneficiary. Typically not corporations, not LLCs, not for-profit enterprises are not generally able to be beneficiaries. I haven't seen very many folks choosing to leave their estate to Microsoft, so it's probably not going to really matter, but can't really do it. It's got to be a live person or a charity. Charitable beneficiaries can be designated through the various tools we talked about, right? Wills, trusts, transfer on death designations. California also recently adopted, and by recently, maybe the last 5 years, the ability to transfer real property upon death using a transfer on death deed. Still not very popular here. There are issues with it. We don't really recommend it a lot, but it's an example, right, of being able to do that. There are situations where maybe that works, but for the most part, we use trusts and other more tried and true ways of transferring property at death. There's also concepts of charitable remainder trusts and charitable lead trusts. We'll talk more about these in detail, but a charitable remainder trust is a type of charitable trust that you can set up, transfer assets into, but yet retain an income stream from those assets during your life or during the life of whomever you list in the trust. And then at death, whatever's left in that account gets transferred to the charity. That's a very common planning technique when it comes to charitable giving. There's also charitable lead trust, which is essentially the same thing, but it's in reverse. The nonprofit or the charity gets the income stream during your life, and then at your death, whatever's left of the asset goes to your heirs. But we'll talk more about those in specifics. Types of bequests, right? Bequest is essentially a gift under a trust, a gift under a will. And bequests can be structured in a number of ways. Specific dollar amounts. I hereby leave $100 to the Cats and Dogs Society. Or they can be a percentage of the estate, right? 20% of my gross estate shall be left to the Cat and Dog Society. You can leave specific personal property or real estate. The house at 123 Main Street shall be left to my daughter, those types of things. And then you also have residual types of requests. You have basically whatever is left in my estate after these gifts have been made goes to X, Y, and Z, right? So those are, residue requests or residual requests. And those are oftentimes charities we see, right? It's sort of, you're giving everything that you want to give, either to your kids, grandkids, friends, neighbors, whomever. And then anything that's left is what is going to the charity, right? And it may be nothing, right? We don't know, but that's sort of the structure. All right, next slide. All right. So now we're getting into the meat of it a little bit here. IRA charitable rollovers. So probably most of you are familiar with IRAs. That's why you're on the call. But an IRA is an individual retirement account, right? And individual retirement accounts have been in the law for a number of years. People are familiar with them in a number of ways. You have 401ks, which is a type of retirement account, 403bs. You have the traditional IRA, which is sort of what we're talking about here. You have self-directed IRAs. This has sort of become an area where there are many options, a myriad of choices, if you will. But for the most part, we're talking about traditional IRAs, which are still sort of the cornerstone of most folks planning. 401k is absolutely probably eclipsed in a lot of ways the IRA, but most everyone has an IRA laying around because it's sort of this flop bucket account. There are many ways in which IRAs can get funded, and they're very simple to set up. They're not directly tied to employment, so you don't have to have a 401k sponsored by your employer to have an IRA, right? So a vast majority of clients I come across have some type of IRA, 401k, something. And honestly, those values have been increasing dramatically over time. And you've probably seen this in your own portfolios, right? It used to be that, people's homes were their primary asset when you were talking about kind of traditional normal estate planning. That's still a major component, certainly, but now we're starting to see kind of these mega 401ks or mega IRAs, as they're often referred to from an industry perspective. And that's really when you have multiple millions of dollars in a retirement account, sort of more than you would ever need probably for retirement. And those accounts can get funded in a number of ways. I think one of the most famous examples of a mega IRA is the creator or one of the creators of PayPal. Thank you. PayPal, right? He basically created a self-directed IRA, put the stock of PayPal into that self-directed IRA, and then sold PayPal for multiple, millions or billions of dollars, right? So now you have this huge IRA that is, essentially holds significant assets, right? Much more than anyone would ever naturally be able to put into a retirement account. There's been some efforts to kind of stream that down a little bit, but we still see very, very large IRA accounts from time to time, which is great because there are lots of things that you can do with them, right? IRAs grow traditionally tax deferred, and then when you take the money out is when you're paying tax on them. Well, a lot of folks don't need the money in those accounts, and we're going to talk about ways in which, if you don't need the money in those accounts, what you can do with them, right? So getting back to rollovers, right? IRS allows older adults, and there's some specific age brackets that have changed from years to years here, but generally speaking, 60 and above is when you're able to start to do some of this fun stuff, right? To make direct transfers from their IRAs to qualified charities. This is unique. This is different than it used to be, because what used to happen, if you wanted to use your IRA for charitable purposes, what you had to do was take a distribution from the IRA, creating a taxable event, and then donate that same dollar amount to the charity. Now, there's some tax triage that happens there that's not exactly helpful. So let's use it as an example, right? You have $100,000 that you would like to leave to the Cat and Dog Society. And in traditional ways, right, what you would do is you would say, okay, well, I'm going to take that $100,000. I'm going to distribute it to myself. Maybe you're subject to mandatory required minimum distributions, or RMDs. I'm going to take this $100,000 and I'm going to turn around and I'm going to donate it to the Cat and Dog Society. But let's pretend that your only income for that year was really this $100,000, right? You didn't have other income. Well, you donated $100,000 to the Cat and Dog Society, but you probably ran into a deduction limit of 50%. And depends on the year. This kind of moves around a little bit too. So even though you gave away $100,000, you were only able to deduct 50,000 of that against your taxes. Now you can carry that deduction that you weren't able to use forward to the next year, but that's not super helpful in the year in which you made the gift, right? The alternative to that would be to make a direct distribution, direct transfer from your IRA to the qualified charity. So we take the exact same scenario. You want to give $100,000 to the Dog and Cat Society, and you just make a direct distribution. You say, okay, from my IRA, this $100,000 shall go to the Dog and Cat Society. You because that never came into your hands, right? It went directly from the IRA to the charity. The rollover is not subject to income tax, and you do not have to go through the rigmarole of taking the money out and then paying the money over to the charity, and then maybe or maybe not getting a full deduction for that, right? And we've seen this happen many, many times where clients, do that, and they say, "Well, I took $500,000 out of my 401k or my IRA, and I donated that $500,000 to, name your charity, but yet the IRS is only giving me, $50,000 or $100,000 worth of deduction because it's based on their adjusted gross income, right? If they have significantly high income, maybe it's not a problem, but a lot of folks don't, particularly when they start taking RMDs. Their income is really not based on, earned income. It's based on distributions and dividends and things like that. So this is a major benefit for those of you that want to start to think about that. Transferring those IRA assets directly to a charity can help avoid taxes on the distribution, as we just talked about, right? It's a benefit to you because it reduces your taxable income, all the while fulfilling philanthropic goals. So, think about it from an RMD perspective. So again, remember, RMDs are, mandatory or required minimum distributions. That's calculated on someone's balance based on their age, based on the account balance, whatever. But these RMDs can be very significant. I have some clients that are required to take, $500,000 out of their retirement accounts on an annual basis, right? Well, you might not need the money. And what do you do with it, right? Well, you can use this IRA charitable rollover to satisfy your RMDs, providing a very efficient way to meet your obligations. What a lot of clients do with those accounts, those RMDs, when they don't need them, they take them, they pay the tax, and then they turn around and put them back into some other type of investment account, right? And okay, that's great. They're keeping the money, but if they really truly don't need it, or their plan is to benefit a charity anyway, or they're doing other giving anyhow, this is definitely a better method, right? Particularly if you're maxing out what you can deduct each year, right? So if you're running into an issue, if you talk to your accountant and your accountant's saying, "Hey, you're writing checks for more than you can deduct from a charitable perspective," this is a great way around that, right? Definitely helps. All right, next slide, please. All right, required minimum distribution. So we talked about this. IRA owners, right, over 73 are required to take minimum distributions from your accounts annually. You're probably starting to see this. It used to be 70 and a half, I think. Now it's 73. But the custodian of your account, Fidelity, Charles Schwab, whomever, right, will reach out to you when you're hitting that age of when you need to start taking RMDs. And they'll calculate the RMDs for you, or your advisor will. They'll say, "This is how much you need to take out of the account," right? And there's no way around it. It's not like you can say, "Well, not this year, I don't want to, or I don't need it," or whatever. IRS doesn't care, right? They're going to make you take it out. And this is, again, all to avoid these huge balances hanging out in the account. And one other common misconception is clients think, "Well, if I just keep this account and I take as little out of it as I possibly can, when I pass away, my kids will get a stepped up basis in the IRA account, and then they won't have to pay any tax." That's not correct. IRA accounts do not benefit from a stepped up basis in the same way other assets do. So your children are going to be put in exactly the same position you are in when it comes to the IRA accounts if they are inherited. The only distinction is under the Secure Act, the IRS gives and the law gives them 10 years effectively for most folks. Some people can go a little bit longer under very specific facts and circumstances. But for the vast majority of Americans, whoever inherits your IRA is going to have to basically pay it out or pay out all the tax on whatever that IRA is over a period of 10 years. So there's no major benefit, if you will, for keeping this account until you pass away. Your kids get a slight benefit, I suppose, if you view that 10-year period of time as a benefit. But it is, but generally though, most people are taking it out pretty much immediately and not maxing out that 10-year period of time statistically. So, don't wait on that if that's the reason why you're waiting, right? There are many other benefits, charities that you can benefit or use it for yourself or whatever, right? But it's not going to get a major benefit at your death. So utilizing these IRA charitable rollovers can help meet RMD requirements, right? We've talked about the tax benefits, right? In our example, right? We're not taking the money into our own hands and then turning around and writing a check. Very inefficient, right? To do it that way. But it used to be the only way you could do it. So this is somewhat new, right? So you may not have heard about it. And it's something that your advisor may or may not be leaning you towards, right? So it's something to ask about. All of the major companies are going to allow you to do this. It's been in the law long enough that no one's going to be surprised when you ask to do an IRA charitable rollover. Not going to be a problem. So again, directing IRA funds to charitable organizations, you can reduce your taxable income and support the chosen causes as opposed to whatever cause the IRS or the federal government has chosen to support with your tax money, right? This is a way for you to directly make that choice. All right, next slide. Okay. Reducing taxable income with rollover gifts. So IRA charitable rollovers, again, they offer significant savings by lowering your adjusted gross income. Well, how does that work, right? So again, kind of circling back here, adjusted gross income is the driver for most of what you're able to deduct, right? And the type of nonprofit that you're giving to will have a direct impact on which basically what the deduction limits are. The highest deduction limit, which is 50% generally speaking, is to a public charity, right? A traditional 501c3 public charity, right? The Ability First or the Dog and Cat Society or others like that, where they are doing public good, right? That has the highest deductibility at 50% of your AGI, generally speaking. So if your AGI, right, is your AGI is $100,000, you're only going to be able to deduct $50,000, right? So not great from a triage perspective, right? With the IRA charitable rollovers, right, you're going to be lowering that adjusted gross income, which may also open up other benefits. Because in the past, if you took an RMD, a required, mandatory required minimum distribution, and that RMD was $100,000, right? That's adding to your adjusted gross income. Maybe kicking you out of certain tax benefits, maybe putting you into the next tax bracket. There's a number of problems there, right? But because you never took the money into your possession, because it went directly to the charity, it never becomes part of your adjusted gross income, and it is a dollar for dollar deduction, right? So instead of having that 50% deductibility limit, it's 100%, right? Which we haven't really seen since COVID. There was a year where they did, 100% deductibility. Again, by reducing your AGI, you're going to benefit from lower taxes, increased eligibility for other deductions and credits. This is especially with the new tax act from Trump, which is about a year and a half old now. There's a number of really great tax benefits in that bill, but every single one of them is subject to some type of income limit, right? And it really is not great if your income is sort of falsely inflated by RMDs. particularly if you're going to turn around and donate a big portion or all of that RMD to a charity, right? You may not, it kind of is like a double whammy. So definitely something that you want to look at. By reducing your AGI, oh yeah, we talked about that, right? The deductions and credits. These are gifts that are not subject to deduction limits. That's huge, right? So, if you want to give $500,000 in a single year to a charity out of your IRA, you can do that and not be subject to all of the requirements or the period of time that you would have to normally deduct that over, right? You just do it 100, you just do it right away, which is very, very good. Um, uh, Again, this allows you to maximize charitable impact without being constrained by these limitations. Big benefit. And you're able to do this while you're alive. Now, some of the things that we're going to talk about in a minute, you can do while you're alive, but some of them kind of happen at your death. These IRA rollover gifts, by the nature of them, can really only be done while you're living, right? Because the IRA account terminates, not really terminates, but starts to get distributed out pursuant to whatever your pay on death beneficiaries are at your death. So really the only way to do this is this way. All right, next slide, please. All right. Donating retirement assets such as IRAs, 401ks, we talked about 403bs and pensions, which, some of you on this call may have some of those pensions laying around. You can do that there as well. So pensions technically qualify. By designating a charity as a beneficiary, you can ensure that your retirement assets are being used for philanthropic purposes, right? If you've already been a big contributor to a particular nonprofit or to a particular cause, using your IRA assets really is a way to make that same dollar go further, right? It also can have a major impact on reducing estate taxes, right? We talked about that. Estate taxes are paid on anything going to a natural person, generally speaking. The spouse is exempt, but assuming both spouses have passed away and now the estate is fully distributing out, you're going to have estate tax on anything over and above whatever the exemption amount is, which is currently $30 million, right? So anything over that is going to be subject to tax. If it's really just extra money and the beneficiaries don't need it, or you want to benefit a specific cause, this would be a great choice, great ability to do this with the retirement assets and IRA accounts. Charities are not taxed when they receive assets from retirement plans, right? Major benefit. So let's pretend that you have some Apple stock that you bought very wisely at $1 a share, right? It's worth something much more than that now. Let's just say it's worth $1,000 a share. So you have a built-in gain there, right, that would be recognized upon your sale of that Apple stock, right? It would be the difference between its value, whatever you sold it for, and whatever you bought it for. In this case, $999,000 difference or delta between those two numbers. So you're going to pay capital gain tax, which is roughly 38% on almost $1,000. So it's a significant number, right? And multiply that by the million shares that you own, it's going to be a lot, right? Haha. So if you did something slightly different, you said, well, look, I'm going to give some of these highly appreciated Apple stocks and Apple shares to Ability First or to another nonprofit, and they are going to turn around and sell those shares. They do not have the same tax event that you have, right? They are not taxed on their income in the same way. So you could give them that stock, they could turn around and sell it, and they would realize the entire $1,000, as opposed to you realizing only something much, much less than that, 600 and something dollars, right? So major difference. So that's a benefit, right? Naming a charity as a beneficiary also has other favorable tax implication for heirs, right? It can reduce the taxable estate. There's many kids that also say, well, look, this is just, we don't want to pay all this tax. We know mom and dad didn't want to pay this tax. How can we do this? This is a great way of sort of reducing that, overall. All right, next slide. All right, so we're going to talk about donor advised funds. So donor advised funds, again, also kind of relatively new, although they've been around a good long time, but they're certainly gaining popularity. Donor advised funds are charitable giving vehicles that allow you as a donor to make a charitable contribution, receive an immediate tax deduction in the year that you made it, and then recommend grants from funds over time. So that's a mouthful. Let's unpack that, right? So typically when you make a gift, right, $100 to the Cats and Dogs Society, you get an immediate tax deduction for that, subject to those limits that we talked about, right? But you get an immediate tax deduction for that because you are, giving it in the year that you made it. Well, sometimes you don't want to necessarily give all of that in one single year, right? Maybe you want to make a large donation, but you're not necessarily ready to give it all away. What a DAF or a donor advised fund allows you to do is it allows you to make a contribution. So let's pretend that you're going to put $100 into your DAF. You get that same tax deduction that you would otherwise get by making the gift directly to the Cats and Dogs Society. But then that $100 stays in the account and it gets invested with your financial advisor. And you get to basically pick from that account over time and make grants to either individuals or other nonprofits over a period of time. So let's pretend that $100 has grown to $500 over the time period that it's been in the DAF. You now have $500 that you're able to distribute out at various times to different charities, right? That's unique. That's interesting. That's different than most types of benefits, and it's a very good one, right? So there's some really nice, strategic advantages there, right? Obviously, the tax benefits, the ability to support multiple charities, right, through a single fund. You're able to say, well, I'm going to give $50 to this charity or $25 to that charity or $10 to this charity. You can do that through your donor advised fund. You can also pass that donor advised fund along at your death, right? So you can say, well, when I pass away, I want the donor advised fund to be managed by my child or managed by these people or whatnot. So they get to basically step in your shoes and use it as a charitable gift. So it's very, very nice. Contributions to DAFs provide an immediate tax deduction in the year of the gift. So if you write a $100 check to a DAF, you're going to get a $100 tax deduction. This timing advantage allows you to optimize your tax situation while still kind of planning for long-term philanthropic goals, right? A lot of my clients have DAFs, and then at the end of the year, right, they will say, okay, well, how much do I need to give to this nonprofit or to the charity or to the DAF? And a DAF is an easy place. It's already set up, and they can do that. DAFs enable donors to make strategic charitable contributions, right? You can keep the money in there until it gets to a particular time. It's almost like a mini foundation, right? You can make a gift over a number of years, those types of things. So very, very flexible, right? And there's a couple of questions. I'll just try to answer these. So one of them is, my understanding talking about RMDs is that it's 70.5, right? It used to be 70.5. It's now 73, and it's going to go to 75. And I don't remember exactly when it's going to go to 75, but I think it's a couple of years from now. So obviously IRS is pushing back that time frame where people need to start taking RMDs, mostly because people are retiring later is kind of the idea, right? The account balances are growing during that period of time, but it will, result in you taking less RMDs depending on how long you live. Richard asks, can we get a copy of the slides? Yes, those will be sent out, I think, after the fact viability first. Do some 401k accounts limit or remove the ability to provide direct charitable distributions, meaning that I need to roll 401k assets to an IRA before a qualified event? Maybe. I think just check with your provider, right? So the 401k accounts are absolutely 100% more limited, generally speaking, than an IRA account. 401k accounts are by the very nature sponsored by your employer. They are kind of built for the masses, right? They're not incredibly flexible. So I think you just talk to whoever manages the 401k and says, hey, I want to do this. It might be that they say you need to distribute something out of your 401k into an IRA and then make this, charitable distribution. It just depends. I do know at least of a couple of 401k companies that do this directly and have allowed for it on their platform, but it's really just what they're set up to do. and capable of doing. So good questions. All right, next slide, please. Oh, Q&A. All right. One thing I'll talk about, because it was on the original slide, but I think it's worth mentioning here. I thought it was a slide, but maybe it's not. On those charitable remainder trusts and charitable lead trusts, right? So what we've talked about here in a little bit of depth is the DAF, the donor advised fund, which is the newest of all of these structures. In many ways the best to some extent. They're very low cost to set up. You don't need an attorney, for example, to set them up. You can set them up directly with your financial advisor. They're very flexible. They're nice, right? I have a DAF. They're great, but they do lack some flexibility, and they do lack some legacy type planning. So sometimes, if a client's going to make a very large gift, probably $5 million and above, we really start thinking about, should this be in some type of family foundation or private foundation, right? Where the family can control this over a long period of time and grow it from $5 million to $50 million or whatever the plan is, and make distributions over time. So depending on kind of how large this gift is going to be, you can talk to your estate planner about whether it's appropriate for a DAF, a donor advised fund, or should it really be something more like a private foundation or some other type of charity like that. Definitely different, right? A private foundation is much like a corporation. There are operating procedures. It's either formed as a corporation or as a trust. It's qualified by the IRS as a nonprofit, and you're operating a business just like Ability First, right? Which is very, very different than just opening up a DAF or donor advised fund. But there again are absolutely advantages to having such a structure. Charitable remainder trusts, right? Those work really, really well when you have an asset that you don't necessarily need direct ownership of any longer, but you really want to continue to get the income. Probably one of the most common reasons we set up a CRT or a charitable remainder trust is like with real property. Let's pretend you have 3 units in Pasadena that you rent out, 3 apartments, and you're really tired of going through the rigmarole of finding new tenants and dealing with replacements and all that stuff. You can create a CRT, charitable remainder trust, donate that property to the charitable remainder trust, and retain an income stream of either between 5 and 50% of the asset through the charitable remainder trust. So a lot of clients will do this. Will create the CRT, will gift the property over to the CRT. CRT will then sell it, and now it has a boatload of cash that it can then use to basically pay you what your rent used to be or more, right, through the CRT. Then at your death, the charity gets whatever remains. So if we put $3 million in, we gave you $1 million worth of income, and now there's $2 million at the end, the charity gets the $2 million at the end. Charitable lead trust is the same thing, but it's just the inverse, right? The charity gets the income stream during your life, and then at your death, your estate or your beneficiaries gets whatever's left of that money. So there's a lot of different options. There's not one size fits all. Some people have multiple things, right? They have a DAF, they have a CRT, and they have a private foundation. They all do different things. So it's just like your probably financial advisor says, well, we don't put it all in certain stocks. We move it around. We have it here. We have it there. Very similar in the context of charitable planning and estate planning generally. So wanted to stop there. I know we've got a little time here for questions, probably 5 more minutes than we need maybe, but obviously, Lana, if you want to go through this slide and tell everybody where we are and how they can reach us.
Sure, absolutely. So we included on the slide our contact information. Please feel free to reach out to us. We have the contact information for both Lagerlof and Ability First. Feel free to call us to schedule a consultation or a meeting. Our websites are listed here as well, and we have offices. Lagerlof's offices are located in Pasadena, El Segundo, and Encino. And Ability First has centers in Pasadena, Claremont, Crestline, Long Beach, and Inglewood. So we are happy to speak with you. Let us know if you have any questions. And thank you, Josh, for answering the questions in the chat. Is there anyone else that has a question?
Don't be shy.
Yeah, Bill Patzer here. Can you hear me?
Hey,
Yes.
Bill.
Yeah, I have a charitable giving account that I use with my Fidelity funds.
Hmm.
Is that the same thing as the DAFS?
It probably is. Yeah. That's probably what they call it, and that's probably what you call it internally. But I would bet at the end of the day, if you dug down into what it's structured at, it's probably structured as a DAF or a DAF. Yeah.
Yeah, that's where I put a certain amount of money from one of my accounts, and then within that new charitable giving account, I can partition it for different charities. That's like a
Yep.
DAF. That's a DAF.
That's a DAF. That's definitely a DAF. Yep.
Okay, thank you.
You're already ahead of the game. Good job. Any other brave souls with questions?
Yeah, while I'm still here, getting coming in for if you come in for a consult, uh, would it be helpful to bring like my my tax filing or something like that with me?
Yeah, it's not a bad idea, right? Because we're looking at ways in which we can potentially, particularly if you're interested in these types of structures, good idea to have at least the kind of the main part of your tax return because we can start to see, what your adjusted gross income is, what you might be able to deduct depending on the different structures. Absolutely. The more information you can bring, usually the better, right? Even if it's not needed in that first meeting, having some of that data available is very, very helpful to make sure that you're avoiding um, excess tax where you don't need to.
Is that a freebie, the consultation?
It is, yeah. There's no cost for that console, whether you're talking about a brand new plan that you've never had before, or if we're talking about modifying something existing. Um, yeah, there is no cost for that.
All right, thank you.
Absolutely.
I have a question for you.
Sure.
Suruji, can you donate directly from the IRA or part of your RMD to the donor advice fund or no?
Yeah, generally you can.
You can.
Yes. Depends on the provider, but most of them are set up to do that. You can because it qualifies effectively as a charity. So you could do that, right? You could make a deduction, a distribution from your RMDs into your DAF, and then choose to make distributions that way.
I see. Okay.
This chat. Hey, does that have any tax implications though, as far as a regular RMD versus a qualified? Because that would mean that you would effectively raise your AGI by the amount of the distribution. Is that correct?
Well, typically yes, but make sure I understand your question, right? You're talking about making a distribution directly to a nonprofit, right? Is that your question?
My question is based on the gentleman's previous question, which
Mm.
means he's taking out a distribution, right? Is that considered to a DAF though, direct, as in no impact to my AGI? Because that's
Right.
important for a lot of
That,
reasons.
that is important. So yes. So if it depending upon the platform that you're on, right? For example, like Fidelity or Charles Schwab or whatnot, um, you can make a direct IRA distribution from an IRA to your DAF in the same manner you would do it directly to another nonprofit. And if you do that, right, you do not increase your AGI as you mentioned, and you do that direct gift. So if you move 100 grand out of your IRA into your DAF, then you've done that without an impact to your AGI,
Yeah,
right? The,
yeah,
yeah,
yeah.
yeah, exactly,
So
which is what you want to do, right? And then you have
exactly
100 grand into your DAF, and then you
because
can write checks to whomever.
yeah, because the thing you didn't touch on, which is one very important area, is IRMA tax, right? That is
Hmm.
based on AGI, right? And all of a sudden,
Correct.
2 years down the line, you're going to be paying a huge amount of a hidden tax, I'll call it, right?
Yeah.
Yeah. So anything that you can do direct is a real advantage.
Anything you can do direct is a real advantage. Typically, anything you could do to keep your AGI lower is a real advantage because you open yourself up to those benefits, the tax credits, and things like that. So yeah, good point.
The other, I have one more point that this is
Sure.
another nuance too, is I believe that any direct distribution is still taxable by California, meaning it's going to show up as your AGI
Mhm.
California, right? But you can use it as a deduction within the
Correct.
California. That's
That's
correct?
right. That's correct. As of right now, that's
Yeah.
correct.
Yeah. So that's another important nuance to understand. So
Yeah, good points.
Josh, we have a question in the chat. I'll read
Sure.
it. Please comment on the requirements and expenses in setting up a foundation. You
Oh,
mentioned
sure.
convening a board. What should one expect for expenses?
Yeah, so foundations are very different, right? They, like I said, they're either formed as a trust or a corporation. There's a nonprofit filing with the IRS that you have to do, as well as California, and then the Attorney General and the Department of Justice. So for a foundation, you should expect 15 to 20 grand to form one. Now, once it's set up, they're not that expensive to maintain, but getting that initial structuring set up is important, and it's not somewhere where you want to kind of pinch pennies, I guess, or not do it right because it'll end up biting you in the butt pretty quickly. Um, so typical foundation structure, right? We do most of them as charitable trusts. They're just easier. It's one less filing with the franchise tax board and Secretary of State that has to be done. But you'd create the charitable trust. You would list in there a board of trustees, effectively, right? That would manage that. Typically, it's three or more. Um, and that is a perpetual trust, right? It goes as long as the trust has money to distribute, and you can fund it. You can put in there terms related to the how long that trust can last. So we have clients that say, have it go as long as possible. We have others that say, I really want this money, whatever I put in here, spend, to have it be spent down within a 10 or 15-year period of time. I don't want it to go on into perpetuity. So you can absolutely put very, specific parameters, in the trust and that and in a corporation, but the trust is easier to do that with. Again, around, the number I gave you could be a little bit more, could be a little bit less if there's something really interesting going on here, or there's a lot of weird assets coming into the trust, commercial property or, business interests, things like that that are going to have to be liquidated. And, once they're in the trust, sometimes that can drive costs up a little bit. But that's a good estimate for you.
Thank you for your question, Deborah. Does anyone else have any questions?
Well, if not, I'll put my email in the chat. It's the info emails there. That'll eventually make its way to me, but the more direct way would be using the email I just put in the chat. Feel free to call, email, reach out. Happy to help on anything that you might come across, or if there's anything additional that you have on the question side.
Thank you so much, Josh, again, for guiding today's conversation and
Of
your
course.
expertise. We will be sending out the link to the webinar recording, and please reach out to us if you have any questions and comments. We'd love to help you. And thank you all for joining us today, and have a wonderful afternoon.
You too. Thanks.
Thank you all.
Bye.
Bye-bye.